And
Okay.
welcome everybody to the new meeting of the Finance Online seminars. It's a real pleasure to introduce today's speaker, Professor Rosario Mantegna, who is Professor of Physics at the Department of Physics and Chemistry at the Palermo University. And as you probably know, Rosario is a pioneer of econophysics, and the title of his talk today is Price Discovery in Financial Markets. And I'm very much looking forward to hearing his insight on this important and exciting topic. As always, following the presentation, we will open the floor for discussion. So obviously, feel free to ask your questions, and you can ask your question by raising your virtual hand using the Zoom menu. And I will manage the queue, of course. And so thank you once again, Rosario, for accepting our invitation, and the floor is yours.
Okay, thank you very much. Thank you very much for the invitation to give this seminar. Let me share some slides. Can you see?
Yes.
Okay, so again, thank you very much for the invitation. And indeed, I mean, my talk today will be about price discovery in financial market. Of course, the title is pretty general. So let me specialize a little bit what I mean with this title. I will just give it to you, I mean, my view of the markets, and as I see the market after, I mean, my activity in research concerning the markets. I have been doing research with financial markets, in financial market, with methods and tools from statistical physics, and primarily from statistical physics and from probably I would say also machine learning. And since approximately 1991, so it's a long period of time. And essentially, this seminar will be a kind of, let's say, short wrap up on the way I see the market. And it will be also a kind of testimony concerning, I mean, the level of complexity that I've been analyzing doing my research. So the outline of my topics on my talk cover these topics. I will consider market as social structures performing information aggregation. I will highlight the fact that you can see in financial market information and noise simultaneously, and considering the fact that you can see this information stored in financial market, the idea is just to see how, I mean, this process of price discovery occurs in the market, and what are the, I mean, some levels of complexity and heterogeneity that you can see. In fact, during my research, I have been analyzing markets at different levels. So at different levels of analysis and complexity. So let's go on. And I mean, I think we all agree that financial markets are pretty complex. I mean, here there are some figures, especially some old figures. You see Wall Street, I mean, the New York Stock Exchange at Wall Street, the entrance of the New York Stock Exchange, and also some figure of what was in the past the pit of a financial market, or some typical, let's say, practitioner that it is working with the financial information and it is performing tradings, or it is acting as a market participant in markets. As a last figure, I'm showing also this one. I don't know. Can you see my mouse?
Yes.
Yes. Okay. You see this last figure, that it is the most recent one of the 4 figures. This is from I think 2012 or 2011, 2012. And this is the data center, one of the data center of the New York Stock Exchange in New Jersey. So indeed, financial markets, have always been open to technology. And especially in the last 20 years, we have seen a huge change, a huge impact of the technology in financial market. And I will also discuss in part that, especially when we will discuss briefly about the specialization that you see in market participants. So what is the typical basic concept in the modeling of a financial market? And I think, everyone will say that, the cornerstone of modern finance is the efficient market hypothesis. What is the efficient market hypothesis that was formalized in the 70s and in the 90s of the last century, primarily by Eugene Fama and a lot of others, finance theorists? The idea is that the financial market acts as an institution where you have information aggregation, and this is done essentially on a time scale which is extremely fast. And typically, you evaluate a financial market as efficient when you can say that if you release additionally some information that it is already known, you will see that this information will not be affecting too much the price dynamic, which means that the idea is that the information is already stored in the time history of the financial prices. Of course, this is an idealization. You need time for that, but the basic idea that you perform information aggregation in market is a very long, it's a very old idea, and goes back at least to Van Hayek, that in his 1945 work wrote the fact that he interpreted the mere fact that there is one price for any commodity or for any good as, let's say, the fact that something that it is not coordinated like a market is, the action that you perform in the market act in a way that you have a price discovery process of the same type that you could imagine in let's say, in something that it is done by the best expert, managing, processing all the information available. So in a sense, markets are another way to evaluate things, evaluate in a rational way things, and this is done through the market activity, Therefore, you imagine that you have a heterogeneity of participants, but the fact that you have this heterogeneity should not affect too much the performance of the information aggregation. Of course, there are limits to this idealization, and in fact, a research area of major challenges to the efficient market hypothesis or to this view of information aggregation is certainly in the area of finance that is called behavioral finance. In fact, in behavioral finance, in the study of behavioral finance, scholars have been able to show that indeed there are some behaviors that cannot be explained by the orthodox view of a complete efficient market, and efficient market participation. You have phenomena like what are called the disposition effect, or limiting the degree of portfolio diversification on bias, this type of phenomena that you can document in the day-by-day activity of financial market. So efficient market hypothesis is certainly an idealization, but works pretty well, especially in highly liquid markets. And this is essentially based on the idea of the fact that you might have what are called arbitrage opportunity. So in markets, you have arbitrage opportunity, which means that if you devise a specific strategy, you can have a strategy that in a given period of time could be successful in giving you a gain with some limited investment or some investment, in the sense that you can recover the entire investment plus some gain. So and indeed there are a lot of market participants that are looking for arbitrage opportunity. And if we do a formulation, let's say a formal formulation of arbitrage opportunity, an arbitrage opportunity is present in a market when an economic actor can devise a trading strategy which is able to provide her or him a financial gain continuously and without risk. Of course, I mean, there are a lot of people investing in the financial market to obtain a gain with respect to their investment, but this is never without risk. If you see some strategy that it is that you can act continuously and without risk, this is an arbitrage opportunity. And but then why? I mean, if you can imagine that you have arbitrage opportunity, why the system is working altogether in the price discovery, under the price discovery aspect. It is working all together because, I mean, if you think a little bit about arbitrage opportunity in an efficient setting, when you have an arbitrage opportunity, if you perform this arbitrage opportunity repeatedly, this implies that demand and supply of the asset are altered. And this means that you act in the direction of moving the price towards the disappearance of the price mismatch. And this is something that you see in competitive markets. What are called competitive markets? In competitive market, you see that indeed it is pretty clear that you have that when you see arbitrage opportunities, these arbitrage opportunities are lasting for a short period of time, or are very difficult to discover, or are lasting for a very short period of time. Within this framework, then the theory, I mean, of the modeling of financial market have concluded that indeed, I mean, if you take this view that the arbitrage opportunities in financial market should be present, should be all very difficult to discover or present for a very short period of time, then the dynamics of the price of a financial market should be consistent with a random walk. And this was first formalized by Samuelson in 1965 with this paper on the proof that properly anticipated price fluctuate randomly. So, which means that the dynamics that you should observe in a financial market for the price of a financial asset is something very close to what, let's say, scholars in sciences are labeling as a random walk. And indeed, when you look at, I mean, how is the profile of the price over time, indeed, you see several aspects that are reminiscent, that are pretty similar to what you see in a random walk. Here I'm showing just, let's say, a plot of the price of the Apple stock in two periods, one about approximately 10 years ago, in two 5 years period. One, the first recorded 10 years ago, and the other, let's say, in the last 5 years. You see in these figures, I mean, the price here in US dollars. Then you see the log of the price. The log of the price, I mean, is an indicator which is of use in the finance, because, I mean, with the log of the price, you model in a better way the dynamics of the price, essentially. I will not go into these technical details, but I mean, there is a reason to use the log of the price instead of the price. And when you do price differences that are called return and are the relative gain or the relative variation of the price, I mean, this return gives you, I mean, the amount that you are gaining or losing at a given time horizon. In this case, the time horizon, in the case of the plots that I'm showing, the time horizon is a daily time horizon, but we will see that you can go down to microseconds, because I mean, the typical fastest time scale nowadays in the majority of financial market are microseconds. So you have a very fast dynamics, but you have also a slow dynamics, and we will discuss this later during the talk. So if we consider that this should be similar to a random walk, and we see that indeed, I mean, by eye, by just simply by a simple inspection of the dynamics, you see something similar to a random walk. Can we do some specific measure just to see whether, I mean, indeed there are evidence of this random walk, more detailed evidence of this random walk? And one of these more detailed evidence, the most basic one, concern what is called the autocorrelation function. I mean, how the return are correlated at different time horizon. And when you do a statistical test of that, and this is the statistical test that I did yesterday for the Apple daily data, you see that you know, the autocorrelation is 1 at lag 0. I mean, when you do something synchronous, but already when you consider what was, I mean, when you want to compare the return today and tomorrow of Apple, you see that the correlation goes to 0. I mean, this dashed line here are the confidence interval of the estimation of the values that I measured in this set of data. And you see that within the confidence interval, essentially what you see is the absence of autocorrelation. So the increments are independent. It is said with a statistical jargon. So you have the increments of the returns that are independent. And this is coherent with the view of the random walk. But it is not indeed the real simple random walk like the one that Brown, for the Brownian motion, investigated in, let's say, in particles suspended in a liquid. It is not really a random walk of the type of the Brownian motion. It is a more sophisticated random walk. Why? For several aspects that I will not discuss in this, let's say, 15 minutes talk. But I mean, if this intrigues you, I mean, there is a huge literature about that, and the random walk. I mean, the walk, the stochastic process is pretty sophisticated. And one of the major sophistication is that the scale of the random walk, you can see here over the time that sometimes you see something that it is more pronounced in terms of the typical scale than in other cases. This the scale of the process of the return, which is called volatility, is itself a random walk, is itself a stochastic process. And this stochastic process has a memory that it is a non-trivial, because has a memory that it is compatible with the power law decay. So from this point of view, you have a sophisticated stochastic process, which is describing the dynamic of the price of a financial asset. But I mean, and the volatility has been studied, I mean, over many years. From time to time, you have a very, let's say, peculiar moment, like for the Black Monday of '87, when the Standard & Poor 500 declined at 20%, or for the financial crisis that was erupting in 2008 in the US. And I mean, and the volatility and for example, we had something very recently when there was the first release of the Trump decision concerning the change in the policy of the commercial trade for the US. So you indeed you track the volatility even at the intraday scale nowadays. You have an index for the volatility. So I'm saying that just to say that the stochastic process, which is underlying the dynamics of the price of the financial asset, is a pretty complex one. But on the other hand, I mean, in natural sciences, when we see a stochastic process, we consider the stochastic process as a noise, as something that it is disturbing the signal that we want to see in a given phenomena. Also in the financial market, we have signals, but we also have a noise, something, I mean, we have because for some strange thing, we need to have simultaneously noise and signal. And the noise is pretty important in the financial market, as we saw by the plot that I have shown to you. But before to go into details for this balance of noise and signal, and noise and information in financial time series, I want to raise your attention to one aspect that it is for me intriguing, and this aspect is about the way we call stochastic processes in natural sciences and in economics. In natural science, you call, as I said, stochastic process as noise. In economics, you called with the term idiosyncratic. Idiosyncratic means that peculiar to the individual. I think that this difference is important. It's important because indeed what we consider noise and what we saw as a noise in the time series of a financial asset in a competitive market are indeed result of some idiosyncratic action. An idiosyncratic action could be just the choice of some individual to trade on that model in a way that could be, in some sense, considered irrational, because, I mean, he had some need on that moment that forced him to act in this way. So then we need to, I mean, we should not be too surprised by the fact that in this institution that are a competitive market, we put together idiosyncratic action and rational action acting in parallel. And this was raised, I mean, this view by one of the, let's say, of the best finance theorists, Fisher-Black, that I mean, the father of one of the most important models in quantitative finance, the Black-Scholes equations. And in a paper of 1986, Fisher-Black highlighted the fact that noise has a profound role in financial market. I mean, noise, as Fisher-Black saw this aspect in terms of a large number of small events, can cause a dynamics by itself. And in fact, it is one of the reasons why you have a liquidity market. And now, in fact, this makes trading possible, because without this aspect, if you imagine, and some theorists have imagined that if you have a complete irrational action, this could even paralyze the activity of competitive markets, because, I mean, there should be no complete, not rational event or trade, and this will mean that you will observe trade only when there is a structural change affecting the information for the entire, for the financial asset considered. So noise is not only, something that has a negative aspect, but it has also a positive aspect in financial market. Make the liquidity, make the action, make the markets more fluid. But this makes also the theory and also the interpretation of what's going on much more difficult. And a bit paradoxical, right? But we saw that indeed, it is not so paradoxical, the fact that we have something like a random walk, that it is sometime described as the walk of a drunk person, a random walk, and we have a huge flux of information and analysis parallel to the market dynamics in competitive markets. So we have a lot of people trying to understand what's going on and proposing interpretation, and the outcome must be something close to the walk of a drunk person. So it's something that we need to familiarize, and in fact, this is what people in finance are doing. Both, noticing that indeed you have information which is present in the market, but simultaneously you have also noise. And one of the challenges was to see where this information, is present. Of course, it is itself in the level of the price, but can we have, let's say, an evidence of the fact that we have information stored in the market by analyzing the history of the market? And in my opinion, one way to see this in a quite clear, with a quite clear approach, is to consider the multivariate time evolution of the log price changes. So if we consider the return, and we perform the correlation among return, log price changes, this is a color-coded representation of a correlation matrix. You see, given provided in terms of a measure that we call distance. The indicator is a distance, this quantity here, which is square root of 2 times 1 minus the correlation coefficient. So when you have a correlation, a cross correlation in this case, which is close to 0, you will have square root of 2, which means a color which is white. And when you have a correlation close to 1, you have a color close to a distance close to 0, which means a stronger red color. And this is a specific case of 100 stock in the US equity market in some past years. And you see that, and if you do something similar today, you will find something very similar. You will see very correlated stocks, highly correlated stocks pairs, and less correlated stocks, like the one which is characterized by this light pink color here. But at first sight, you don't see too much about information. You see that you have correlated stocks and less correlated stocks. How this can be put in relation with the fact that you have information and noise simultaneously in the multivariate time evolution of the system. This can be seen by, let's say, by constructing what in statistics are called null models. And for example, if you imagine a null model of some really random, pure Gaussian random evolution, then you have a support, a theoretical support for that in terms of what is called random matrix theory. And the group of Jean-Philippe Bouchot 25 years ago, or a bit more than 25 years ago, shown that indeed, if you do this for real data for a very competitive financial market like the US market, you see that you have something close to what you expect in theory for a random aspect. This is seen not in prices, but it is seen in what is called the spectrum of the eigenvalues of the correlation matrix. It's something technical, but what I want to say to you is that you have a way to compare things to something that you know by construction that it is completely random. And when you do that, you see that there are some values that are difficult to interpret, but others that are this peak here, and especially these peak years that are informed in this peak year, they are extremely clearly that it is extremely clear that they are outside this possibility. So you have something that it is information, it is there. And this information, another way to see that was proposed by myself, the same year, and just by doing a hierarchical clustering of the return time series and reorganizing. And when you do hierarchical clustering and study the different clusters, you see, and in this color figure, the colors are related to the economic sector of each stock. And you see the colors are ordered together. And when you put, for example, the matrix that I was showing you before with the order of the hierarchical clustering, you see some structure. And you see, for example, that utilities are weakly correlated with all the others, and financial are pretty strongly correlated with all the other stocks. Therefore, you can see that, you have information that it is stored into the coevolution of the dynamics of the log price of the system. So this means that indeed you have this information. And in fact, people know that this information, for example, is present for pairs or groups of stocks. And there are arbitrage opportunity constructed on top of that. The most famous is the one concerning pair trading, for example. So from this point of view, this is clarify what I was saying before, that you certainly have information and idiosyncratic aspect stored in the time evolution of the log of the price of the financial asset. So the system works in the sense that indeed you store a huge amount of information in time series. Competitive markets are performing this process. How is the way to do that? How information and noise are both recorded in the time series of the asset return. This is due through the economic action of all the market participants, of course. But can we see specialization of that? Can we see that the intrinsic organization need the interrelationship and specialization of the role inside the market? And but before, so I think we have another 20 minutes. So then probably we go very fast on this. This is a famous cartoon that The Economist published on its cover when there was the Asian crisis, 1997, in financial markets. And you see that sometimes you can start with something that it is idiosyncratic. I've got a stock here that could excel. This is interpreted excel in some way. People try to interpret this behavior, is why this guy is saying excel. Someone misinterprets sell, and this could start a cascade of selling, or vice versa. In the presence of the sell, some guy could say, I want to leave the market for the moment and say goodbye. Someone interprets buy start to be buy, and then another cascade could happen. Indeed, you have simultaneously noise and information which is present, and discriminating between the two is pretty hard. This is the basic game, which is at any time present in competitive markets. But let's see in a bit more detail the structure of the market, just to introduce, the way that I want to highlight to you concerning the specialization that you observe in market. Typically, we nowadays we have the idea that we can trade in any market. If we have just an account on some provider, you can on some banks, you can buy and sell essentially any financial asset traded in regulated market or around the world. When the market is regulated, you can have individuals that are acting in the market, indeed act through what is called probably a broker or a market member, or a chain of market member, a chain constituted by broker and market member. And this is and the same is for individual and institution. So the system is organized in layers. So you have the layer, you have the broker. Some market member can be both a broker, can have a brokerage house and could act as a market member. So the point is that the point that I want to highlight is that typically in regulated market, to perform a transaction, you need to go through a market member. A market member is a member of the venue and has the right to act in the market. And then it is plausible, for example, to see how the market members are acting in the market when they are acting with the profile of market members. And we did a study of that a few years ago with Federico Musciotto and Jyrki Pilo, and because we wanted to put in evidence the huge technological change that has occurred in the last 20 years. We had the opportunity to investigate the trading of market members at the London Stock Exchange in the period 2004-2006. We had a special version of the Rebuild Order Book with the shadowed identity of market members. And we investigated another venue, which is the Stockholm venue of the Nordic stock Nasdaq Nordic market. That it is a venue owned by Nasdaq. So Nasdaq has also the property of the Nasdaq Nordic markets, and especially in from 2010 to 2011 and from 2018, during this period from 2010 to 2018, the Stockholm venue of the Nasdaq market, for regulatory issue, released the identity of the market members that were performing any transaction. So these were a special set of data where we couldn't track the activity of each market member. Why we were interested to that? Because, as I said, during this period, there was a really huge change concerning what are called high-frequency traders, which means traders that are able to act into the market on a time scale which is for time intervals with a duration below a few milliseconds. So something that a human cannot do, because the human reaction time is about 200 milliseconds. So if something is done below 200 milliseconds, this means that it is done by a computer. Of course, the computer is programmed by humans, but the action, the trading action is performed by computers. So, I mean, this was something that started to be diffused at the beginning of 2000, and nowadays more than 50 or 60% of all transactions, essentially in all competitive markets, are done by computers. So this means that there has been a very important change in the way, at least, very fast transactions are performed in the market. So this was the, let's say, the research question that we wanted to investigate. Can we see effect of this in the price discovery? I mean, Nasdaq is a very has very advanced technology, which means that the Nasdaq Nordic, that was using the same technology as Nasdaq in the US, provided a platform which was allowing in 2016, you see from this slide, more than 1 million messages per second at sub 40 microsecond speed, which means that, I mean, the technological state of the art of the Nasdaq Nordic is absolutely compelling, as absolutely at the best level. And not only that, but also, I mean, large companies specialized in high-frequency trading were also active in Stockholm. And here, I mean, I'm just showing the list of market members that were present in 2018 in Stockholm, and highlighted in yellow, there are companies that were known as able to perform high-frequency trading, or because they were stating that in their website, or because, I mean, they were described as high-frequency traders by the specialized news. So when we started to analyze the activity, of course, I mean, this is done through an electronic order book. In the electronic order book, you have what are called limit orders and limit orders and market orders. The limit orders are divided in buy limit orders and sell limit orders. I mean, what is a limit order? Limit order is the fact that you send to the market the information that you are willing to buy or to sell a given amount at a given price. Here, I mean, the bar indicates the amount, and the position in the X position indicated the price. So typically you have a best ask, which is the best price that you can see concerning the sell limit order. There are people that are willing to sell at this price, but not less. And there are people that are willing to buy at this price, but not less. This is continuously updated electronically. And in fact, you have a cancellation. Sometimes you change your mind. You have a cancellation, or you have a market order. There was something willing to buy, and there is someone willing to sell. And when someone is willing to sell at the best available price, he or she is sending a market order. And for this reason, and you have a dynamics on that. When you are selling a market order, you are called the aggressor. I mean, in the jargon of the market, you are called the aggressor. And the participant that was submitting the limit order is called the counterpart, because the one that takes the action of performing the transaction is the aggressor, and the other stay there waiting for someone that is willing to accept the price that that is proposed in the limit order. So we had access to this type of data, and we couldn't highlight who was the aggressor and who was the counterpart, not in terms of individual actors, market participants, but in terms of market member. So we had this information, and we used this information, and we analyzed all the market members, and we investigated whether, I mean, it was possible to see that there was a kind of, let's say, spatial trading activity between pairs of market members concerning their role of aggressor or counterpart. And this can be done with some statistical validation tools. We devised a statistical validation of the pairwise trading, and in particular, we were interested in highlighting the overexpression and the underexpression of the trading activity concerning a given asset in a given period of time. We devised a statistical test, and we performed the statistical test. And what we saw was that if we analyze it in terms of networks, so in terms of pairwise relationship, the interaction of the different market members, indeed we see something that it is statistically validated against a null hypothesis, and it is showing that indeed different market members have a different specialization. And in particular, you see here, I mean, I'm highlighting the network in the sense that I'm describing each market members in terms of their tick symbols that are these 3 letters code, and here there are the names of the different market members. The stock that was traded, was analyzed by us, was SKF in Stockholm, in the Nordic, in the Stockholm venue of the Nordic Nasdaq, and we saw that for 9 months or more, a persistence of this type of relationship, in the fact that you know, the market members that were not of the type of high frequency trading, were not performing high frequency trading, were in touch with other market members that were acting as high frequency trading, because the high frequency traders acted essentially as in the jargon of financial market makers. They are the one that doing continuously buying and selling and gain on this activity. The others are more acting in terms of their investment. Notice that this was done through an anonymous limit order. So the limit order was anonymous, but the system structured itself, and there were not specialized market makers. The market makers were specialized earlier in other, for example, in the New York Stock Exchange until the late 90s. But nowadays, I mean, they are not often specialized market makers, which means that the system organizes itself in the specialization through the market activity. And this is a similar plot where I'm showing the underexpressed, which means the fact that essentially the market makers avoid themselves, avoided not, in spite of the fact that, you know, as I already said, the limit order is anonymous. In spite of that fact, they have, I mean, through their strategy, they are able to minimize the interaction among the the market makers, the high-frequency traders themselves. And this is then, and also among, let's say, large-scale investors. So the system organizes itself in a way where specialization emerge. Another thing that I would like to raise to your attention is the time scale of the phenomena. You can, for example, estimate what is called the time to fill. The time to fill is the time that you observe between the submission of a limit order and the subsequent action of the market order concerning that specific limit order. So this is we have the entire order book, so we can extract the time to fill for all the filled order, and we can compare the median of this time to fill for each pair of interaction. And this is something that it is spanning 8 orders of magnitude. So in each competitive market, the time scales that you see in the action of this socio-technical system span 8 orders of magnitude, from tenths of microseconds to several hours. This is a huge interval of order of magnitude. This is one of, I mean, it is, for example, let's say in a natural phenomenon, it's pretty hard to see the spanning of this number of order of magnitude in a specific process. But this is something that occurs any time in competitive markets. I think I have another 5 minutes, right? Okay. So let me say a few other words concerning post-trade processing. Typically, in financial market, you have the execution of a trade, and we saw something in my previous slides. You have what is called the clearing. The clearing is the fact that you have other institutions related to the market venues where let's say the back office, but often it is called the back office. In this back office, someone is checking that indeed the transaction is can be cleared. It's because you have sufficient margin stored, you have recorded properly the transaction, and everything was done according to the rules. And then you have the settlement, the physical exchange of the property, of the security exchanged for money. So in financial market, then in addition to this type of data, the data concerning the order book, in principle, you also have this type of information that refer to the legal entities. But typically, of course, I mean, accessing to this data is extremely complex, and indeed, this data for several countries even does not exist, in the sense that can be collected only from the supervisor agencies, and they are not recorded by some institution, for example. Why? Because the way the settling is done, and it is because it is related to different legal constraints. Typically, you have a country, you have a venue which is working under the rule of a given country. For example, Sweden in the case of Stockholm, or Helsinki in the case of Finland. And then you have a cross-border investment, and you have a brokerage from cross-border. So you have a very complex system where you have action occurring in different countries, and you have legal constraints that are referring to different countries. The system is organized in a way that for each country, you have typically a central security depository. the central security depositor control the information concerning the ownership of the financial asset issued in a specific country. Typically, this information is not centralized, but it is distributed on a chain of custodians, because banks act as custodians, and the most typical organization in Western world is that there is not a single, even if you have the central security depository, the information concerning the ownership does not go down to the specific legal entity. But typically you have a custody chain that comprises normally from 3 to 4, but sometimes from 2 to even 10 intermediary between the central security depository and the end investor. So this means that it is extremely hard to monitor the behavior of single legal entities, but there is an exception, and the exception again are in Nordic countries. And in fact, Sweden and Finland have what is called a direct holding system. So they track the information at the level of the single individual investors. For individual, I mean an individual legal entity. I mean, this is true, completely true for Finland. It is compulsory. It could be called, it depends on Sweden, because in Sweden you can ask to be owner registered. So you need to ask to be owner registered. In Finland, it is automatic that you are owner registered over time, which means that Finland is a very, let's say, exceptional laboratory to track the dynamics of investment of individual legal entities. And in fact, we have studied this, we and other scholars have studied this, and for example, we studied for a very important company, Nokia, and I have no time to go through, but the point was that by building up an analysis in terms of categorical variable concerning the buy state, the fact that an investor is primarily buying at a given time, or the sell state, that an investor is primarily selling, or a buy-sell state, what we could do is to see whether there is let's say, a behavior of groups of investors that are highly similar among them. This can be done by analyzing the system in a proper way. Why in a proper way? Because, as I said, the system is highly heterogeneous. There are agents, for example, a bank, performing hundreds of thousands of transactions in a period of 1 year, and others that are just performing other legal entities, households, real individuals that are performing, for example, just a single transaction. So, by doing this analysis in this way, you can see, regularities. And I think I have to stop here. If you're curious about that, you can see my papers on the study of the specific profile of groups of investors in a financial market. And let me briefly conclude. So I think we can say that indeed financial competitive markets are heterogeneous open systems processing information. The knowledge of the information is providing marginal advantage, and therefore the process of information aggregation is complex and pretty rich. You see specialization of market participant when you observe the system at different levels of investigation. And you also can see trading activity of individual investors And you can see patterns of this activity over a very long period of time, sometimes evolving so slowly that you can track this over a period of more than 10 years. And after that, thank you very much for your attention.
And thank you very much, Rosario, for this very, very interesting paper. And I guess there are a lot of questions coming from the audience, and so we can now open the debate. And everybody, of course, can ask questions. You can ask questions by raising your hands, your virtual hand on the Zoom menu. Okay, so of course I have okay, there's a question.
Oh, yeah, one, two.
Okay, so there is M. Dolph. I don't know the name, but the first one is M. Dolph. So M. Dolph, you can show yourself.
Can I talk? Yeah, can I talk?
Yeah.
Yes.
Yeah, sorry. So I don't know why it is M. Dolph, but actually I'm Marina Dolphin. Thank you, Professor Mantegna. It was really a beautiful occasion to talk to your presentation, to have this opportunity for your presentation. So I would like, to just double check my comprehension. So basically, my one said that you are, for instance, in the paper that you presented, you were depicting heterogeneity among investors by basically distinguishing heterogeneous, so high-frequency traders versus, say, normal traders. So is this, say, the message, the main message, or am I wrong?
No, the point is that, I mean, our analysis was, imagine that we started from the order book. And as I said, the order book is anonymous. So, I mean, when the limit order and market order arrive in the market, they arrive in an anonymous way. But then there is the dynamic, and in 2018, still in Sweden, I mean, after the transaction, there was let's say it was published the identity of the market member. Nowadays, they also removed this information, so it is no more like that.
Yeah.
But the point was, and as I said briefly in the case of Finland, also in Sweden, of course, for example, Citadel or Morgan Stanley or other big or Deutsche Bank. I mean, they are the different market members are not equivalent. Some of them are trading extremely often, and others are trading rarely, let's say, or less frequently. So the systems are always in financial market, in competitive market, heterogeneous. Our methodology is robust with respect to heterogeneity. So our null hypothesis include the heterogeneity. So what we observe is an overexpression or underexpression with respect to the heterogeneity. So we are not just analyzing the heterogeneity, but the deviation on top of that. And in terms of the deviation on top of that, we were able to see that, I mean, there are preferential exchange links between, let's say, the different market members, highlighting that you had, for example, flux of orders that were, for example, from retail investors channeled in some other thing. It is known that some of these large high-frequency traders are buying, let's say, flows of transaction from retail investors sometimes, and they are mixing this on their trading because it's a kind of game where you need to hide and act simultaneously. And this is done in very complex ways. I mean, our study was just, our aim was to show that indeed you can extract from if you know the information concerning the market members, you can extract information concerning the specialization that they had for a given stock in a given period with respect to other, for example, market members, highlighting that sometimes some of them, for example, compete, or some of them are doing similar strategies or different strategies. And we had evidence, and in the paper there is evidence, especially in the supplementary information, of the fact that you can see dynamics of these different trading strategy or trading approaches.
I see. Thank you. Thank you a lot.
You're welcome.
Thank you, Rosario, and thank you for the questions. And there is now Pietro. I see Pietro.
Yes. Hi, Rosario. We met through the econophysics here in Amsterdam, by the way. So nice to meet you again. So I have a couple of well, first of all, a question about the time to fill the orders that you mentioned is from 0.1 microseconds to several hours. Can be dependent on the size of the order, and especially if we are talking about standard lots versus non-standard lots, because that is also a point maybe to consider. Then the other thing is that about basically the relationship between, let's say, a kind of background volatility that should be there in order to trade. Was any study done, for example, comparing volatility versus trading volume of a stock? So, for example, we are talking about small cap stocks. We are expecting them to be consistently less volatile because they are less traded. However, my hypothesis is that we shouldn't look only at the level of the volatility, but also as a kind of quality of the volatility. So the shape of a volatility in terms of kurtosis, because I mean, what makes me a little bit uncomfortable is that volatility, correlation, covariance, they are kind of cumulative measures. So basically they are summations, right? So if you have a very high term and then the rest zero, is exactly the same result as you would have a constant series of very small terms. So I wanted to ask you if state of the art, there are maybe a little bit better measures to capture basically the heterogeneous effect on the distribution of the volatility or something like that.
The first question was, I mean, you had two questions before.
The first was more a comment, was about the standard lots, but maybe that will influence also the speed of filling. But
no, of course, I mean, this was in both cases the main limit order book of the system. And you were asking concerning the decides, but typically, of course, you have the decides of the orders there. It's a kind of self-regulated level. Of course, you cannot trade a huge amount. I mean, because of course this would impact you would have an impact, a huge impact. Concerning volatility, to be honest, you know, as you probably know, volatility is, I mean, the modeling of volatility is a key aspect. So, you see some regularities, and you see some, I think, for example, I mean, you have a huge amount of research on that. And for this reason, I mean, I have nothing to say more than to advise you to see. I mean, you know, there are many models. It depends on in a sense on what is the best current description of the volatility.
Yeah, my point is that, for example, I mean, this correlation matrix of distance matrix, according to you, do they remain stable over time, or
the correlation matrix is another stuff, right? because no, the correlation have a dynamics that could be have a dynamics, certainly. No, the correlation is not stable.
No.
But the correlation has some recurrent, again, it's not stable. You can see, especially when you have a crisis, you can see a strong dynamics, but you see also regularities in the sense that you have a stability of some basic underlying aspect. You know, for example, and there is a lot again about that, and also ongoing research concerning, I mean, what should be the best use of the information? I mean, the most recent one, or sometime you just consider a very long period of time and just focus on the average behavior. Sometimes, I mean, some counterintuitive aspect are there, because even if you see some static property, you see some gain from some static that you impose on the dynamic of cross correlation, and on the other hand, you also see that there is a role of the underlying dynamics of the market, especially if you have some huge collective behavior like a crisis or a huge gain. So both things are present, and it is really hard to balance what should be better used of the two. And I think this is a kind of art that you can.
To the top of your mind, do you know if there was any study done with the Cornish-Fisher expansion on the volatility, so to include basically higher momenta to the volatility?
No, I don't know that. I mean, it's not a field that I follow in very detailed. So, but perhaps that there is.
Thank you.
We don't know.
Thank you very much, Pietro, for your interesting questions. And we now move to the next questions. I see Marco.
Hello, hi, can you hear me?
Yes.
Yeah, thank you.
Hi, Professor Mantegna. It's been a pleasure listening to you. We know each other for a long time, although, you know, we took different paths, maybe Canberra, if you remember, back in the early 2000s.
Yeah.
I don't know, do you remember?
20 years ago.
More than 20 years. Yes. We took slightly different path from now. Now been a quant for almost 20 years. So change a bit, but it's always a pleasure to see you and listen to your talk. So I just want to, you know, I mean, tease you a little bit, but for you, you know, it's been a long time, and I remember the excitement back in the days when the econophysics started, the first econophysics conference, and so on and so forth. Obviously, I moved away, so I lost a bit track of the whole thing, and probably that says something. So, in your opinion, along from the start of the general question, I just want to know your opinion. In these 25 years that econophysics set in, what are, you know, the most important achievements that has been done and physics has brought to finance? I think one thing that I remember back in the days, talking like, as you said, 25 years ago or so, it was the excitement, these new things, we're gonna do this, we're gonna do that. And then it seems it calmed down a little bit. So in these 20 years, what do you think that physics brought to economics that the economics, people from economics didn't have before?
Yeah, but you know, I will say, I mean, certainly this approach of starting from data, which now, of course, it is also followed by economists, at that time was a bit controversial. because the view was that first you had to perform a micro foundation of what you were looking for, highlight in a pretty precise way what was your statistical methodology, and then perhaps build a model. And in a sense, I mean, both. I mean, we as physicists working in this field, started to be more accurate in the statistical setting. And in fact, I mean, I think this was something where we have contributed. We have contributed. I mean, what has been the contribution? One contribution has been to suggest or to propose alternative stochastic processes, univariate stochastic process. For example, multifractal models, that alternative. This is a good contribution that I believe. The other has been concerning the multivariate approach, and stressing the fact that you might have used machine learning approaches for that, and this could be informative, and this could suggest conclusions that are important conclusions from the point of view of the modeling in finance. Nowadays, I mean, this is accepted but I would say 10 years ago, I was talking at a dinner with a prominent economist. And when I was, let's say, saying that, I mean, we had a different approach in treating data and starting from the evidence, the empirical evidence, and the fact that empirical evidence were suggesting limits and potential of different methodological approaches. I mean, this colleague said to me and to the other at the dinner, but this is fishing. You know, their idea was that this was just fishing, you know, something that had no knowledge value. I think that this has changed in the economics, and this colleague was wrong. Nowadays, I mean, but now economists are also fishing like us, you know, because you need to start by fishing, and then also starting from the fishes to build different models. And when a model is not consistent with the fish that you obtain, you should forget the model.
Yeah.
Even if it is beautiful. Sometimes they are beautiful, but they are not just representing the real fishes, you know.
Yeah, I understand. This is also a discussion I had with
And let
show
me say another thing.
Yeah.
Another contribution of econophysics, I think, has been the use of networks. Of course, networks and cyber-complex networks. So the impact of complex networks in the modeling of finance and economics is something that I think has contributed on a better understanding of several even key problems.
I wanted to remark a thing. As I was talking to Bush a few times and about this thing that you mentioned, starting from the fish, like from the data. And whereas economics traditionally had an opposite approach, they start with the idea and they don't. And, you know, of course, Bouchot had the same view that as a practitioner,
I'm not saying that it is not important to develop models. You know, I don't want to be, say, misinterpreted. I think, I mean, some of the models, the economic models are really beautiful and really important and really informative. But the point is that, you know, you at least my opinion is that you can say that you will not consider something because it is just bottom up. You know, it's
no, absolutely.
And this was a position of leading economist. I believe it is no more like that, but it was like that. And in part, probably it is still like that.
From my point of view, from a practical point of view, because I have to build models to make money at the end of the day, sometimes the approach starting from data, as you mentioned, has the drawback or leading to overfitting, right? Like you can do in machine learning, which is the biggest problem in finance.
Yeah.
So sometimes I don't even have the data. So I have the idea, I have the model, and I don't have the data. I don't have enough statistical data to prove that I'm right or wrong. I just have to go with, let's say,
but this
with
is
what
another,
I think is
another,
right. So sometimes it's also a practical problem that you don't have
true,
enough data.
That's
and
true.
if you only use data, you could, if you only rely exclusively on data, you definitely overfit in the end, and you can make your data say whatever they are. So there has to be a balance there, right?
Yeah, I agree.
Oh, anyway, that's all. I mean, it was really, I think we could talk for a long time, Professor Mantegna, but I was in Sicily last week. I was in Trapani, close. I thought about coming, but my wife didn't agree. So maybe another time when I come to Palermo, we can sit, have a coffee, and continue the conversation. Yes. And I'll leave to other people that want to ask you questions. Thank you very much again.
You're welcome.
Okay. Thank you very much, Marco, for your questions, also for bringing your viewpoint, or practitioner viewpoint. I see a question coming from Carlos. Yes, Carlos, yes. Benavides Riveros.
Yes, thank you. I am a physicist, a quantum physicist, and I occasionally work also in quantitative finance, although not always. So I have a question that came to my mind, let's say, or comes to my mind time to time. Maybe it's too simple for you. If it's too simple, feel free not to answer. But when you present these correlations and you base or you study this matrix of correlation between assets, I usually I listen that people say in finance returns. So you have the covariance or the correlation returns. But to me, it's a kind of surprising that there is in the books or in the papers, maybe it's too obvious for the people working in finance. But if I use daily returns or 1 month returns or 1 year returns, I obtain always completely different results. In particular, because the matrix of daily returns is too noisy, or because you need data, or sometimes you don't have all the data.
Of course, I mean, there is a huge literature about that. Of course, I mean, depending on the time horizon, you are using different data.
So
the dynamics.
How do you choose the time horizon?
Pardon?
How do you choose this time horizon?
It depends on the problem that you want to see. Of course, if you want to see how the correlation evolve, let's say intraday, you need to look at intraday. If you consider, let's say, daily data already, I mean, you have an horizon that could be of the order of at least 6 months. If you want something on a very long time scale, again, I mean, it's something that can focus on just some aspect of the correlation margin. Because as I said, you have aspects that are pretty stable over a very long period of time, even decades, and other aspects that could depend a lot on the specific time period. But this you can manage. I mean, and you can see also in the literature that sometimes you have a kind of the need of balance the fact that if you want to track the dynamics of the correlation, then you need to look at up to a given time horizon, because you need a certain number of records to estimate the correlation, and you have also uncertainty on the estimation, statistical uncertainty. But this is, I mean, there is a large literature on that.
I see. In the numerics you present, what kind of returns did you use?
I was presenting daily data.
Daily data. Okay. Thank you.
Thank you very much, Carlo, for your question. And we have another question coming from Ali.
Yeah, can you hear me?
Yeah, but we can see you now.
Yeah. Thank you for great talk, Professor Mantegna. So I have a question, but this is a physics-based question, actually. In physics, we are interested in dynamics. So as I know, you and many physicists thinking about, power laws and dynamics in financial data. So the question is that for this huge amount of data, tick data, high frequency data, if we are able to detect some kind of power laws, specifically, I mean some specific power laws. So how I can interpret this idea, because after years and many years, we find out some dynamics in context of this data. So I want to know about this more, and also, if I'm able to distinguish the information about the market in two ways. In one way is that about how these traders are in a one group or a set of groups, but in other ways, how they behave with each other is exactly the dynamics. So as I understand, something I understood from your talk, we know mostly about the structure of how they are in a one group or several group, in the network dynamics, but we don't know more about information about how the dynamics of traders, informed traders are. So also let me know about the context of a little bit about, chaos and dynamics. As I know you mentioned some things in your books about econophysics, but at that talk you didn't mention anything about chaos in context of this data. Thank you very much.
No, I mean, the description in terms of, nonlinear processes, I don't think that there is let's say, a long-term potential of description of the price dynamics in terms of nonlinear. Of course, you have nonlinearity, but this does not mean that you have a static nonlinear system or just an attractor of a given dimensionality of these type of things. So this is not something that I believe is there. Concerning power laws, in a sense, the fact that power laws are, in a sense, frequently observed in finance and in economics comes from Mandelbrot work, Benoit Mandelbrot, right? And indeed, I mean, you have, and this is the observation that sometimes you need some distribution, some probability density function, which is scale invariant. So it seems that some of the processes that are social processes, starting from language and then going to, let's say, to income and then to the, for example, to large variation of the return at short time scale. This is consistent with the absence of a scale. It's a scale invariant, and this is the reason why power law distribution are so frequent in this social system. And the fact that I was highlighting the observation that you have 8 order of magnitudes in the time scale of the time to fill means that indeed you see something that it is intrinsic. You have an heterogeneity that imply that let's say the market members have needs that can cover a time horizon, a time scale as wide as 8 order of magnitude. And when you have something like that, this means that you have something that some process that probably is scale invariant, some aspect that it is scale invariant.
Okay. Thank you very much, Ali, for your question, and Rosario for your answers. So time is up, and I don't see other questions coming from the audience. So I think we can stop here. I would like to thank one more time Rosario for his talk and kindness, and all the participants and their questions. And I hope to see you again on the next Finance Online seminars. So, bye.
Bye. Bye. Thank you.